Hey, everybody, this is AJ. I am with a company called Trading Trainer, and I'm giving a presentation today about selling option premium, how I create a seven-figure income selling option premium, and how you can apply this same method. Now, I've got a few slides, and my presentation today is more learning related than it is selling. So if you could, make sure you have a few sheets of paper out and a pen or a pencil. If you're feeling very confident, let's use the pen. Otherwise, pencil's good because you can erase. And take a lot of notes because you should be able to walk away from this presentation with a lot in your hands. I'm also going to be showing you some live examples of some different trades that we've done. I've got my trading platform open, so we'll look at that as well. All right, but because I am on a time limit, I am going to keep going. Hey, my mentor, so we all have mentors, right? Guided discovery is what it's called. It's so much faster to learn through guided discovery than it is to learn from trial and error, right? It's better not to recreate the wheel, and you can get the same kind of experience out of it, but it's shortcutted. So I have a mentor. In fact, I've got a handful of mentors, but my mentor posted on Facebook on April 16th. It was pretty hilarious, but I wanted to start off my presentation with this, just kind of giggle with me here. He wrote, "I just hate to be the guy that breaks this to you, but most of the self-described experts out there have their heads firmly up their arses," right? "There are shortcuts to success, but none involve magic. Shame on you if you get involved in some scheme that you know in the back of your mind sounds too good to be true." And I thought that was just so clear. I mean, Trading Trainer's been around since 2003, and we've been pretty much teaching the same thing, people how to trade stocks and options since then. And there's a reason why we're not one of those companies that comes and goes. With that said, I want you to take a look at this chart. This is the type of chart that I think is amazing. Now, you might say, wait, that's boring. It's not going up. It's not going down. It's going sideways. And a lot of stock charts spend a lot of time going sideways. These are the boring patterns that I make a lot of money on because I sell options for income. So I wanted to kind of imprint that, tattoo that chart in your mind. We'll be looking at more charts like that moving forward. So here are a couple of facts, because we know that the market is selling off, right? The Fed is raising interest rates. That's causing fear in the market. They're also selling their bonds, which means that a lot of cash that was magically created a couple of years back has now started the process of being dissolved. So there's a lot of money flowing out of the markets, and that's creating a lot of uncertainty with what's happening. And add to that, we've got conflicts in Europe, we've got supply confusion, we've got still traces of the pandemic that is affecting economies. All of that is uncertain. But I want to tell you that what is happening in the markets, if you play it right, can set you up for months, if not years to come. In fact, if you don't mind taking some homework from me, I really suggest you go, if you haven't already or you haven't in a while, go check out that movie, The Big Short. It had people like Steve Carell, and it had that really cool Christian Bale in it. This was about the 2008 financial crisis, but it applies now as well. And it shows what happens if you can be on the correct side of the equation, right? Because despite what the talking heads keep telling us, money is not created or destroyed in the markets. You know, I saw a headline, "Oh my gosh, so many trillions dollars of people's 401k vanished today." No, it didn't. It simply moved from one person's hand to another. In other words, the key is putting yourself on the correct side of the transaction, figuring out a way to make sure you're receiving the money, not losing the money. And so I hate to tell you this, but for those of you that have kind of a buy and hold mentality for the long run, where you buy symbols in the stock market or you buy indexes or ETFs, you're going to see some short-term losses because the market's on a downturn. But if you know the correct strategies, and listen, options are the fantastic vehicle to take advantage of those strategies, right? Because when you're just trading the underlying symbol, like stocks, ETF indexes, all you can do is go long or go short. You can either trade the market going up or trade the market going down. And if you want to trade it short, you have to have a margin account, right? Which means you have to have an agreement with your broker, show some experience, even put some money on the line. But with options, we can go long or go short the market with cash transactions, but also options can allow you to profit on a whole bunch of other things. So options, I love them. Obviously, I've been teaching them for almost 20 years now. And the scoop is they give you the flexibility to trade the markets in all these ways that can put yourself on the correct side of the transaction. So I want to give a shout out to both Dave and Ann Anka for having me on, because this is my favorite cup of tea. Let me ask you this before we get going. I want to know what would be ideal for you. And if you could just type this into the chat. Are you somebody who likes to learn how to invest for low risk and high return? In other words, be one of those people who's 100% self-reliant. You want to learn how to fish for yourself. Or are you somebody who likes to invest and have seasoned investors review what you're about to do before you go ahead and execute them? In other words, you want to learn how to fish, but you want to fish in a group of expert fishermen. Or finally, maybe you're somebody who wants to do what seasoned investors do in their own portfolio. In other words, you're one of those people who likes to fish alongside expert fishermen, watch what they do and just do what they do. You're not really in there to kind of figure out exactly how to do it yourself. Or maybe you're here to learn something else. Could you just let me know? Because I'm trying to tailor today's presentation, this afternoon's presentation, but I want you to be honest about which category you fall into, so I can, okay, I got a lot of A's, I got a lot of C's, interestingly enough. Okay, I'm getting an idea. We'll see if we can get this going here. Okay, I always like to begin in the beginning of my presentation. I like to review this. Now, you've probably seen this a bazillion times, so just humor me. It'll only take a second. If I gave you $50,000 in cash today, would you take it? Or if I promised you a penny that doubles every day for a month, which would you take? So $50,000 in cash, we know what that's all about. But let's go through the penny. So day 1, day 2, day 3. Don't forget, though, even though I'm promising that you double your money every day for a month, there is work involved with that. There was not really much work with you just accepting the 50,000. So after 7 days of work, you have a grand total of 64 cents. You're about a fourth of the way through the month. And I hate to tell you this, but that $50,000 looking really good. Let's keep going through, though. All right, day 8, we've got $1.28. Day 9. Okay, we're about a third of the way through the month. We've been doubling our penny, $5.12. Awesome, right? Nothing like 50,000. We're about a factor of 10,000 off. I'm starting to wonder if I've got the stick-to-itiveness to stick it through the whole month. All right. We're about 2 weeks into the month, and we have a grand total of $81.92. All right. I'm going to bring us to 3 weeks. Okay. After 3 weeks, 21 days of hard work, we're almost done with the month. And now we're a factor of 5 away, $10,485.76. And then finally, at day 24, we're about more than 2/3 of the way through the month, and we finally surpassed the $50,000, and that brings us all the way up to the end of the month, where we walk away with $21,474,836.48. So obviously, and all of you wrote it in the chat, you said the penny was the way you wanted to go. But I want you to also realize that it's misleading, right? Because it's very exponential. And so the first almost, 24 days of a 31-day month, the first 24 days, it looked like we weren't making any money. And it has to be that we stay solid with our plan and we don't get distracted by shiny objects, right? This is all an illustration of, well, it's attributed to Albert Einstein. I'm not sure if he actually said it, but let's just go with it. Compound interest, it's the most powerful force in the universe. Now, I want you to look at this because I'm actually going to show you a trade that has a lot to do with this chart. I like to imprint images. Just take a look at how this chart kind of goes from the left to the right, and it exponentially gains over time. We'll come back to this chart. So I reverse engineered this. This is simple interest, not compound interest. But if we focus on just getting the gains, I know people have been talking to you about, making home runs and stuff like that. But if we focus on just growing our portfolio by 6% every month, then our investment will double every year. That's like doubling the penny, right? So I like to focus on hitting the moon. And if I hit the stars, great. But 6% is my thought process. I'm not worrying about trades that double or anything like that, right? All right. So if I focus on just 6% per month and hit that target or beat that target, then $1,000 investment portfolio will double in 12 months. In 2 years, it'll be $4,048. In 5 years, it's $33,000. And in 10 years, 10 years, I'm a bona fide millionaire, right? And so this is really my focus. My focus is not to be a day trader, right? That's the last thing I want to do. When I quit my job in 2005, I used to work for a company called Hewlett-Packard. When I quit Hewlett-Packard in 2005, the last thing I wanted to do was replace that job with another job. So I'm an end of day options trader. I don't I don't jump into the market during the days just because, right? Instead, I'm actually like a fund manager. I treat everything as a business and investment, and I just follow my plan every evening, right? I'm more into spending time with my family and spending time with my passions, not spending time with my computer. Even better than, letting that money sit for 10 years. If you grow your portfolio to $100,000, then that means every year you'll be generating about $101,219.65. Now, that is more money than the mean income of somebody who is on salary. The difference is I'm working just a few minutes every month or a few minutes every evening. I don't want to oversell this. I spend about 10-15 minutes every evening looking at charts versus 80 hours a week, 60 to 80 hours a week, which is what the average salaried employee is doing. So very cool. So what is it I'm investing in? A lot of you know about options. What we're doing is we are selling the theta decay optimized option premium. Now you might say, what the heck? That's got a lot of buzzwords. I'm profiting on time passing by. So like I said, options can profit on directional moves. They can profit on volatility changes, but one of their most reliable ways of profiting on them is on time passing by. And that's exactly what I'm doing. So before I go any further, I just want to make sure you're paying attention. What minimum returns are we trying to make monthly on our portfolio to double our money annually? Is it 0.5%, 1.5%, 5%, 6%, 10%? Go ahead and type that into the chat. Let me see what you got. Good. 6%. You got it. Write that down. Now, some of you are familiar with options. Some of you aren't. Aren't they risky, right? That's the number one thing people say. So we talked about how easy it is if you're buying stocks, buying ETFs, buying indexes to make money if the market goes up. And you can short them if you have a margin account and make money if the market goes down. But options also allow you to make money if the market goes sideways, and they make it easier to make money up or down. So you can make money if the market goes in any direction. Options also allow us to make money on time passing by. In fact, options allow us to make money if there is fear or confidence in the markets, right? So trading stocks, indexes, ETFs, two ways to trade them. Options, the last time the mathematicians went through all the combinations and permutations, 26 different ways to profit from all the different patterns. So again, that's why I'm attracted to stocks and options, because of their flexibility. So what is this option for those of you that don't know? It's a financial instrument, right? It's a derivative. And they're typically bought and sold to hedge against risk. They do this for people who have big positions in stocks, indexes, and ETFs. But that's not how I'm using them. Instead, I'm selling their premium to generate income. Let me explain a little bit more. Do you guys know who I am, by the way? If you know who I am, maybe I can speed past these slides. How many of you, just with a little message, already have been introduced to me? You know about me, AJ Brown, because I don't have to tell you about me. I can save some of my time in my presentation. Let me know in the chat if you already know who I am. If you don't know who I am, also let me know. Okay. I'm getting an equal number of no's as yeses. So I'll just speed through this really quick. First of all, you can definitely follow any of these links, just like David has his podcasts and his YouTube channels and stuff. I'm on Facebook. I'm on Twitter. In fact, I'm now on Instagram and TikTok. That's not listed up here. I have to update these slides. You could also check out the articles I write. I write a lot of articles. I also write a lot of white papers. I've been doing this a long time. And if you just want to talk to me, just phone me, right? And make sure, just like we said with David's channel, if you visit any of my stuff, please give it a thumbs up, subscribe, and turn on any notifications if you want to follow me some more. I founded this company called Trading Trainer. They call me the world's most disciplined options trader. I actually think behind my back, they call me the most laziest options trader. I think I like to think of myself as the most efficient options trader. That's because I like to do the minimum amount of work, take on the minimum amount of risk, and also worry the minimum amount, when trades go against me, in order to get the max return. So I'm all about efficiencies, right? I've been doing this since 1997. I started my company in 2003, but before that, I actually started publishing my daily insights in 2002. There's an ebook that you find on every successful options trader's computer called The 7 Strategies of Successful Option Traders. It's still selling to this day. I'm just amazingly surprised that 17 years later, it's still selling. I also have a home study course that's still selling. But the main thing I want to put out to you is that I am a learner just like you. I mean, I went to college. I got a mechanical engineering degree. I also got a electrical and mechanical engineering master's degree, a focus on automatic controls. That means supposedly I was supposed to go into business working on fly-by-wire systems or these automatic driving systems like in the Tesla car. But instead, I went into marketing and wound up getting a strong background in commercial business and also investing. And in the last 15 years, since I started Trading Trainer, I've really been educating or re-educating myself into how to teach people the stuff I know. I've been taking a whole bunch of courses and getting certified in how to do accelerated learning so that even old dogs can learn new tricks from me. And just know that when I first started in 1997, not only did I spend $27,000 on seminars, in fact, that was just the first year. I'm still spending quite a lot on seminars. I like to go out, especially if somebody's promising the world. I like to see what they're doing. But that first year in 1997, and this was back before seminars were on the web. This is where you had to go to the hotel and you had to sit through half a day on Saturday, and then they'd sell you to come back for the whole day on Sunday. And then the next thing you know, you're on a plane somewhere. Do you guys remember that? How many of you, with a little message in the chat, remember when seminars were in hotels? Some of them still are, but most of them have gone on the line. Not only did I spend that much money on seminars, but I gave $85,000 back to the market. I figured I was getting another college degree. I invested more in my stupid investments than I did in my college education, both my undergrad and master's combined. Listen, this is how I finally started to be successful. You may want to take a note here. First of all, I stopped chasing shiny objects. I settled on one type of investing and I learned it well. In my case, options, equities, ETFs, indexes, stocks, right? That's what I focused on. I didn't want to be bothered. At one point, Forex became popular, then crypto became popular, commodities, futures. I mean, you name it, baseball cards, real estate. But I just wanted to focus on equities and options because I knew about the flexibility of options. Also, trial and error. I mentioned it in the beginning. I liked it. What I did was I hired a mentor, and that mentor was currently doing what I wanted to do, and he knew how to teach it. And that was awesome. So I recommend you learn from guided discovery. It's much easier than learning and much less expensive than learning from trial and error. Also, join an investment group, right? And don't just join the investment group to have, rah-rahs and accountability and all of that. That's all great, but join it so that you can look over each other's shoulders. In grade school, they used to tell us not to cheat, but in the grown-up world, I want you to leverage with pride. I want you to look over other investors' shoulder. And finally, surround yourself with like-minded investors. People who are not investors will tell you how risky your endeavors are, and they'll convince you that you're wrong. And it creates a voice in the back of your head that will just mess you up, especially when you're getting into the trades that you know are right, but everybody. So make sure you surround yourself with people who have the same thought process. Okay, hope you got that down. Let's get back into the topic. One more thing about me, and that's my foundation. I never forget to tell you about my historically underserved inner city kids. I started this also in 2003. So in addition, I consider myself a little bit of a Robin Hood. In addition to, having this school where people would pay me to learn how to do options, I also started working with inner city kids. And I started in 2003 with just these 9 kids, right? And at the end of my 6 months with them, I actually did something crazy. I gave them each $2,000. And I thought I'd have to write that off as losses because I'd never see it again. I'll let you know that every single one of those kids that first year paid me back my money. In fact, most of them went on. We did this in the public library, where back in 2003, we were on a DSL dial-up connection, and they were limiting us on the computer to just 30 minutes per day. And so we would go to the library and spend our 30 minutes per day. And I'll tell you, we were all successful, and they wound up paying me my money back, buying themselves their own computers and their own internet connections. One of them is actually now a teacher at a community college in Colorado, teaching, teenagers how to think about money. It's quite awesome. We've been doing this every year. In fact, we moved this from Colorado to Chicago, where there's quite a lot of historically underserved inner city kids. I think the last year that we pulled this off, we've actually partnered with the CBOE. We graduated more than 200 of these kids. So it's quite awesome. Okay. How do we sell premium? 4 simple transactions. Writing covered calls. This one's really important because the market is going down. Writing covered puts, in other words, flipping the covered call upside down so that it's set up to profit on the downside. Make sure you write that down. Then we like to supercharge this, writing covered calls against leaps, For you academics out there, we call those bull call diagonal debit spreads. We do a variation of them. This is supercharging your covered call writing. And we can do the same thing on the covered puts. This is called a bear put diagonal debit spread. We can write our covered puts against leaps as well. Now, notice the covered calls against the leaps and the covered puts against the leaps. These are cash trades. So you can do them in your retirement account. And that really is wonderful for tax benefits. Covered puts is the only transaction where the covering position is a margin trade. So you need a margin account. So keep that in mind. A lot of folks like to focus on just cash trading just for the simplicity of that. So just know that the 4 transactions we're talking about, 3 of them are cash transactions. So great. A lot of you are still saying, what the heck does he mean by option premium? So if you look at any option price on the big board, it's going to have 2 components, right? An in the money value or intrinsic value and a premium value or extrinsic value. So if you take that option price, just know there's these 2 components, the intrinsic value and the extrinsic value. So let's do an example. Last time I checked on the price of Ford, it was trading at about $12.75. Now this was about a week ago. $12.75. So if we were to, I'm going to just demonstrate a very simple transaction here. If we were to buy some shares of Ford and then immediately sell back the Ford July 15th $13 call, we would get a 63-cent rebate. This would act as a discount against the Ford stock. In other words, it would reduce my break-even price on the Ford stock. That option that I sold also acts as like an expiring coupon, because as July 15th approaches, it's going to wind up getting less and less value till it expires worthless, which is good because I get to capture its money before it starts to lose its value. And it's going to act as like an instant dividend. And this is how I make income on selling options. I'm going to be making $63 per option contract sold. Options are sold in lots of 100 shares. So that's why I make $63 for a 63-cent option. So let's run through the scenarios of what might happen. This is the covered call. So it's one of those 3 strategies. So if Ford were to close above $13 on July 15th, I would have spent $12.75 on the Ford stock shares. I'd get the $13 back because I'd get exercise. So that would give me 25 cents per share profit. But don't forget, I also got to capture the 63 cents per share profit for a total profit of 88 cents or 7.3% ROI. That's if I get called out or exercised out of the option. But what if Ford is flat by July 15? So I pay the $12.75 per share for Ford stock. I get the 63 cents. That 63 cents expires worthless, which means I get to log the 63 cents. I get to keep it. But I also keep the Ford shares of stock. This is actually the ideal case because I want to create an ongoing income. So I just made 5.2% ROI so far, and I'm going to do it again and again and again. This is what I try to do with those sideways moving stocks. Just keep collecting income, like rent out the stock. Instead of having to deal with tenants, trash, and toilets by renting out real estate, I'm just renting out these stocks. These stocks don't wear the way that real estate does. Does that make sense? Now, what happens if Ford drops? Now, this is in the case of a covered call. If Ford drops by July 15, okay. So I spent $12.75 on the Ford stock. I got the 63 cents for selling that call back. That means my break-even price is $12.12. In other words, that stock has to drop all the way down below $12.12 before my position is even in the red. Now, I'm going to show you in just a few minutes how I can reduce the risk on return even further, but inherent in these strategies is this profit buffer. In this case, the profit buffer is 63 cents per option sold. Now, before I go on any further, I'm going to show you a very similar trade that actually we did. That was all theoretical. That was a sample. This is a trade we did on AT&T. So on May 3rd, we went ahead and bought 500 shares of AT&T stock for $19.42 a share. Spent about $10,000, right? And then on May 9th, a few days later, the timing was right. We went ahead and sold our May 20th, 1950 call, right? So we got 48 cents back in an instant dividend. A profit buffer was created for 48 cents. This was a discount against the stock. And of course, it's going to act as an expiring coupon, which it did, because on May 20th, it expired. And on May 20th, we actually got exercised. We got called out. We got that $19.50. All in all, it doesn't look like much, but I made 2.8% from May 3rd to May 20th. In those 17 days, I made a return of 2.8%. Now, you might say that doesn't sound like much, but man, even with the Fed raising interest rates, if I put my money into anything else that has just as little risk as this, I wouldn't be making 2.8% per month, would I? So that's on the overall position. All right, we'll look at more of these examples as we go on. But before we go on, I want you to make sure, or I want to make sure we're all on the same page. So this was an example of selling call premium. We could also sell put premium, which a lot of people are doing right now, and I recommend it highly. What does investing in by selling premium create? Does it create an instant dividend, a discount on a security, a profit buffer, an expiring coupon? I want you to tell me it could actually be more than one. It could be 1, 2, 3, 4 of these. What do you think? Let me know in the chat section what answers you think apply here. All right. I think we're getting the right answers here, because most people are saying all or A, B, C, D. Exactly. All of this is true. Now, I am going to start getting a little bit more complicated here. And so I'm going to ask you the question in advance. How can we lower how much we invest into this, increase our returns, and even convert a margin trade into a cash trade? I kind of alluded to it earlier when I laid out the 4 strategies that my program participants and I are using like religiously. Should we sell out in time options? Should we replace the security with options trading at parity? Should we just give up and buy mutual funds? Or is what I'm talking about not even possible? What do you think? A, B, C, or D? Bob says B. A lot of people are saying B. Dave said B. The answer, of course, is B. Wonderful. So what does that mean? Option trading at parity. So option premium, the stuff we like to sell, is the most when the option is at the money. But when we go so deep in the money, the option actually changes its personality. It has very little premium. In fact, we like to target less than 5%. And it turns out to be almost completely in the money or intrinsic value. Now, what the frick does all that mean? It means that a deep in the money option behaves exactly like the underlying security. Dollar for dollar. So if the underlying security is at $100 and moves up $10, that option is going to move up $10. It's going to behave just like the security, but it's going to be cheaper. Yeah, it's called leverage. And you might say, okay, I get it. Go deep in the money, but how far out in time? Well, here's something you should take note of. Participants in my program who do this with me, on average, their positions last about 5 months. That means they can sell premium against them, collect the income against them for 5 months. Now, that turns out to be a very flat bell curve. So that means some of them only last 2 months, 3 months, 4 months, 5, 6, 7, 8. It turns out there's a big drop off after 8 months. So my recommendation is when you buy your back month option far out in time, you want to make sure that it's not going to expire when you're still selling premium against it. Wouldn't that suck if you were collecting rents on a piece of real estate and then all of a sudden you were collecting all this money every month and the house dissolved and you have to stop collecting premium? You don't want that to happen. Instead, you want to be exercised out. So what I usually recommend is go at least 8 months out in time. That way you'll be covered. And we typically use what we call option leaps. It's just because there's more liquidity than there. We like to have liquidity in our option chain. So, okay, let's find a substitute that trades at parity on that Ford option. Remember the Ford, last time I checked, the price was at $12.75. It turns out we can buy an option trading at parity. This is the Ford June 16th, 2023. This is more than 8 months out. $5 call. It's only $7.80. It's just a little bit over half the price. And you can see here, this is a perfect example of an option that's pretty much all in the money value. It's trading dollar for dollar. Ford goes up $1, so will this option, right? All right. So I buy what we call a back month option. I buy this June $5 call expiring next year. Then I still sell the same front month option, the Ford July 15th, $13 call. Again, this is a diagonal debit spread if you think about it, for those of you that have some academic history in options. So I sell this call for 63 cents. It acts like an instant dividend. It's the same thing. It acts as a discount. It reduces my break-even price, and it's going to be like an expiring coupon. So let's run through the scenarios. What if Ford closes above $13 on July 15th? All right. I spent $7.80 on that $5 call. I get to keep the difference. So the difference between the $5 strike price and the $13 strike price, this is what makes it a spread. I got to keep the spread $8 if I get exercised out. That's a 20-cent profit per share. Don't forget, I got to keep the 63 cents too for selling the front month up front, which gives me a total profit if I get exercised out, if I get called out, of 83 cents per share, or 11.6% ROI. Now, is that much better than what we had by doing it on the stock? Absolutely. And remember, I'm focusing on 6% ROI, aren't I? So 11.6%, that's double digits. That's awesome. In fact, most of my program participants are making these type of returns. They're not doubling their money every year. They're doubling their money about every 5 to 6 months. Makes things go faster. But again, aim for the moon. Maybe you'll get to the stars. What if the ideal case happens? What if Ford is flat by July 15th? Remember, I like these boring sideways stocks, so I can keep selling my premium against this. Okay, I spent $7.80 on that back month call. I collected the 63 cents when I sold the front month call. I get to keep that 63 cents because the option expired worthless. I made 8.8% ROI so far. And I'm going to do it again and again and again. But also, what happens if it drops? Inherent in this strategy is a profit buffer, right? The back month option would have to drop all the way to $7.17 for me to even think about having a problem, for this even to be going into the red. So inherent in this strategy is a profit buffer. But I'm also about to show you how we can reduce our risk on return even further. But I just want to emphasize one more time, these strategies have profit buffers built in. All right, before we go any further, I'm going to show you another trade that we did that kind of falls into this category. This is on Shell. This is a fuel stock, right? Shell, some of you buy your gas at Shell gas stations. So Shell was a little bit expensive, right? If I come over here and I take a look at my trading platform, and I pull up Shell, SHEL, you can see that Shell's trading up in the $55 range, $52 range, things like that. So too expensive. Instead, I substituted the Shell January 2023. This is the LEAP $40 call. This thing only cost me $15.30 per share. I bought 6 contracts, just under $10,000. And then a few days later, on May 9th, I got my signal to short the front month option. So here we are with our Shell May 20th, $55 call. The May 20th, $55 call, I got $1.80 back. And then I just waited. So you'll notice I'm not day trading. I did one transaction on April 28th. I did another transaction on May 9th. On May 20th, it expired and I actually got exercised out. Great. When I got exercised out, I got to keep the difference between the 2 strike prices. That's called the spread. So 55 minus 40, I got $15. You'll notice I'm also calculating the commissions that I had to pay. $15 back. I wound up walking away with $1.48 per share, or 9.7% ROI on the initial investment. So leverage helps, right? This is a very simple trade, 2 simple transactions about 2 weeks apart, and then I waited for expiration and cashed in. Okay. So remember, we're focusing on 6%. If we focus on 6% and we get it every month, investment's more than going to double every year. Now, here's where we reveal the special sauce. How can we drastically reduce our risk on return? What do you think? Sell half as much option premium, sell out in time options, collar the investment by marrying a protective option, or is what I'm talking about not even possible? What do you think? A lot of people are saying C, and the people who are saying C are absolutely right. We're going to collar this investment. So let's go through that process. Remember this trade? This is actually a chart documenting a trade that has been going on for me for more than 14 months. Now, remember, I told you that most trades don't last past 8 months. This one has been going on for forever, right? It started in August 26, 2020. And I just want to kind of demonstrate here. So we bought Pan American Silver. We bought this stock because it was nice sideways moving stock, boring, right? Silver mines, $34.73 per share. Now, what we did is, in addition to selling the premium, you'll see here I sold the premium for $1.76. I also bought a protective option. In this case, it was a protective put. You'll notice I bought my protective put. Any price below $34, that would stop the risk completely, right? Because what's going to happen is this protective put will gain in value by the same amount as any losses I have once you hit the strike price. So that's what marrying a protective option does. It stops the risk at that strike price. Now, I paid a pretty penny for it, $4.75. So I wound up actually paying a little bit more than the premium I captured. And you might be saying, well, that doesn't make any sense. Well, it actually does. Check this out. The third Friday of the month, by the way, on the third Friday of the month is when options expire, the monthly options expire. And those are my paydays, right? You could also do weekly options. That means you have the opportunity to profit every Friday. But I love the third Friday of the month. So the third Friday of September, the option expired. It expired worthless, which means I got to keep that $1.76. And then because I didn't need the protective option anymore, I went ahead and rolled it out. A few days later, it was actually after the weekend, I went ahead and rolled the option out. And because of the strategic way that we buy these protective options, not only do we buy the protective option to protect our trade while we've got the premium sold, but it sets us up for rolling out and making a profit. And this is where I differ from a lot of my peers out there. My peers buy protective options and they actually cost them money. What happens in our trades is every time we sell our protective option back when we don't need it anymore, we make money. We do that by going about 3 to 6 months out. So you'll notice here, not only did I make $1.76 that first month on selling the premium, I wound up making what? $1.15 on rolling out the protective option. Then the second month came. I made $1.47 selling premium. I bought the protective option for $3 and a penny. Then I sold the protective option back for $3.62. So not only did I make the $1.47, I went ahead and made an additional 61 cents. And that's how we do it. So not only are we making money on selling premium, we're also making money rolling out the protective option. We have two sources of income in the economy. Now you might say that gets confusing. Not really. Listen, I make a transaction on August 26th. I make 2 transactions on September 1. It's not like I'm day trading. I'm simply making a transaction about once every other week, right? September 18 rolls around. That happens automatically. The expiration date is the expiration date. So I'm making about 2 to 3 transactions a month, and I'm getting paid back big time. And we just keep doing it over and over. But here's what I also want you to look at. This cost basis is otherwise known as the break-even price. Notice how quickly, right, I'm insuring this position for the underlying symbol going below $34. Notice how quickly it goes below $34. In other words, I'm insuring the position for more money than I have in the trade. What does that mean? If I'm guaranteed to get paid at the worst case scenario, $34, and you can see here, the cost basis keeps going down, 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 I'm actually locking in a risk-free trade. Let that settle for a second. That's actually what we're showing here, right? So this is the break-even line. And so you can see this is what happens if the position goes against you or goes for you. Above the orange line is if it goes for you and you get exercised out. Against you is below the gray line if you wind up getting bailed out, right? Stopped out. So early on, this is the average time. 5 months is how long our premium trades tend to last. And so if they go for the 5 months, you'll notice that if I get exercised, I'm setting myself up for a 65% ROI. If it goes 6 or 7 months, it exponentially increases, right? But the other cool thing is if the position goes against me after 5 months, I'm still guaranteed 50% profit, right? So we select these positions so that they actually will last as long as possible. I'm not in there buying and selling symbol. That symbol stays as long as it can. That back month option stays as long as it can. See, here's the beautiful part. You see that line that I just drew? That's when this position becomes risk-free. Just in the first month of owning the position, right? This is how long before the position becomes risk-free. Somebody asked, when can you lose in these trades? Well, if you aren't very good at selecting them, then in the first month, you might have a chance where the position could go against you, and it only would go against you a little tiny bit. But as the position matures, you're guaranteed to make money whether it goes against you or not. See, time is what we're trading here. So just to review, what do we have when our cost basis or break-even price is less than our protective bailout price? Do we have a risk-free investment? Do we have a losing trade? Too much complexity, or are we smoking the crack pipe again? See, we very quickly have a risk-free trade. So let's review the exact 3 steps, and then we'll call it a day. We're going to buy or short an underlying security, or instead of doing that, instead of buying or shorting a stock, an index, or an ETF. Let's buy a substitute option that's trading at parity. Then we're going to sell a near-term at-the-money option for its premium value. We're going to collect an instant dividend and set up a profit buffer. And also we're going to collar with a married option that is 3 to 6 months out in expiration to protect your investment. Write down these steps. Here's the timing, right? We use some really cool timing that we share with our program participants when they join our program so they can invest alongside with us. But if you're doing covered calls on these sideways moving, then we wait for a bottom. We buy our underlying, or we buy a call option trading at parity. We put a stop loss in place to protect our risk. And then at the top, that's when we're going to sell the near-term call option and buy our put option, protective put option, 3 to 6 months out. That near-term call option expires on the 3rd Friday of the month. We sell back that put option when we don't need it anymore. Rinse and repeat, rinse and repeat. And of course, because the market's going down now, a lot of us are doing the opposite. Instead of doing talk about this very much. And am I still sharing my screen here?
Yeah, it sounded like there was a glitch for a second, but
okay, you can hear me still?
Yeah, it's back to normal now.
And you can still see my screen, right?
Yes.
Thanks, David. So even better, let's think about shorting our underlying symbol, or even better, buying a put option trading at parity. That's a cash trade. And let's put in place our bailout. In this case, we'll bail out to the top side. Then let's sell at the bottoms, near-term put options, buy our protective call options. It's the same thing. Bob's your uncle. The near-term put option will expire worthless on its own. We'll roll out the call option, rinse and repeat, rinse and repeat. So in these last 4 minutes, 5 minutes of my presentation, I do want to let you know, how would you like to never miss a pick, minimize the amount of time you spend away from your loved ones, have support whenever you need it? That's what it's all about. It's all about saving time, creating clarity. It's all about getting results. So would it be okay if I take the last few minutes to tell you a little bit about my materials, my training, and my tools to see if this might be a match for you? Okay, cool. I really appreciate that. This is definitely for someone who doesn't want to pay for a bunch of different data subscriptions. They want everything they need in just one place. They don't want to miss any opportunities. They want to spend more time doing other things than just sitting in front of the computer. They don't want to do this alone, and they do want step-by-step instructions. This is someone who wants to get consistent and also reliable results. So if you fit this template, you may want to perk up your ears. I'm going to pass this testimonial, but the testimonials, let me just show you really quick. So this is, you'll get immediate access to the web portal. And in this web portal, you'll notice that we've got the tutorials. We also have our once a month webinars. These are lecture series where I like to do deep dives, and you'll notice I like to get into the teaching mode. But every week we do a workshop with everybody, and people either log in for the workshop or they watch the replay when they have time on their own. And in this workshop together, we find the best candidate to trade for the week, and we actually plan it out. Like for instance, if I click here, you'll notice, I got to watch my time because I know I'm getting to the end here. You will notice that I have a listing of all the previous symbols we've been going on. And you'll notice that there is a replay. And in addition to the replay, let's look at this one. That one was just posted. Let's look at TIVA because I'm actually trading TIVA right now as we speak. Below the replay and below the transcript of the replay, we actually have the configuration as well as the back test so that people can just trade it the way that we described on the workshop. And if you missed the workshop, you can just log in and check it out and just follow the plan, right? That's what it's all about. In fact, we give you planning tools. In addition to giving you planning tools, we also give you screeners. I've got some beta screeners that I've been working on. We also have the main daily picks screener and the premium selling screener. So we can find those perfect candidates. There's also one more piece that I have to tell you about: the video tutorials, the monthly live classes, the screeners, the planning tools, the weekly live workshops, and their rate is the trade review. So what I like to do, especially for folks who are just joining the program, but it's for the whole time you're part of the program, is I like to review personally your trade plans. I like to make sure you haven't missed anything. So I have a way in the right here under Learning Center and right here, trading questions. I have a way for you to actually, this is a messaging system that comes directly to me. It doesn't go through spam filters or anything like that. And you can attach your trade plan. We give you the tool that fills out your trade plan for you. Attach it. And before you do any sort of trading, I want to review your trade for you. So what is that all worth to you? Well, how about if I throw in a double your money back guarantee? I want you to work for me. Now, you'll probably pick this up because it's quite easy to pick up in about a week or two, depending on how studious you are. Could be even faster than that. But I want you to actually trade with me for a full 6 months. I want you to send me your trade plans. I want to look over your shoulder and I want to have you make money. If at the end of 6 months, you're not turning a profit, not only do I want to give you your money back that you paid for this program, but I want to double it. Yes, I know it's unheard of. I've been offering this double your money back guarantee since 2007. Also, I'm going to give you a strategy session with one of my coaches where you can talk about where you are now, where you're going to be, and how to get there fast. So what's all that worth to you? Adding in those couple of bonuses, the double your money back guarantee. Well, the price of the program is typically $597, but for Synergy Trader, by the way, that's a flat fee. You're not going to be put into a subscription. That's for 6 months of working with me. But I want to reduce that to $497. So I'm going to take $100 off. How do you do that? You go to optionsinvesting.org/synergy. When you do that, you'll come to a page that looks like this. And please write down this program, this promo code, because that's how you're going to get the discount. It's 100 capital DISC. So for instance, if I come down here, you see it says $597. But if I put in the 100 DISC and click apply, it should, cross your fingers. Yes, it reduces the price to $497. So do not pass go. Do not collect $200. You can also, if that's too confusing, give me a call. That's my phone number. Optionsinvesting.org/synergy. David, is there a way to put that? Should I just type that into the chat area? Oh, Anka did it. And she also put the promo code. Thanks, Anka. And that brings us to the end of my presentation. Somebody asks, what size account? Listen, I've had people start with as little as $800, but I'm not going to lie. If you don't have an account that's about $2,000 or $3,000 at a minimum, it's going to be a little bit difficult for you to get started, but it will definitely speed up from there. But if you've got $2,000 to $3,000 or more, you're good to go. Thank you, David. Thank you, Anka. Thank you, everybody, for sitting through my presentation. I hope you picked something out of this.